Free and clear of the chatter from Wall Street, you're listening to Talking Stocks Over a Beer, hosted by hedge fund veteran and newsletter writer Mike Alkin, who helps ordinary investors level the playing field against the pros by bringing you market insights and interviews with corporate executives and institutional investors. Mike sifts through all the noise of mainstream financial media and Wall Street to help you focus on what really matters in the markets. And now, here's your host, Mike Alkin.
Welcome to the podcast. It's Tuesday, April 17th. Hope you had a good weekend. I had a good one. NHL playoffs are in full swing. And for me, as a hockey fan, the NHL playoffs are as good as it gets. I mean, the intensity level that these guys bring every night, shift after shift, they just leave everything on the ice. And if you play hockey, you could so appreciate what they're feeling out there. To every single time each guy hits the ice, it's 30, 45, 60 seconds of all-out intensity. And if you play, you know what that burning in your legs is like. You know what one shift like that is. And then to do it for 60 minutes and to do it night in and night out and the pounding these guys take, it's just awesome to watch, to see guys competing at this level. And then you get the overtime games. I think it was Friday night. I was up till 2:15, 2:30 watching the Vegas Knights and the LA Kings, watching the Jonathan Quick, the goalie for the Kings, just stand on his head. He was so unbelievable. I love this time of year. Playoff hockey is just nothing better for me. My Mets continued on a tear, started the season 12-2 so far. But I got to tell you, I'm a born and bred short seller, so I'm skeptical. I keep waiting for half the pitching staff to go down with injuries because why wouldn't they? They're the Mets. But so it was a good weekend. Sat out on the lacrosse field yesterday. My kid played. It was freezing. I underdressed, and it was just 2 hours of misery. And again, you've heard me complain. I sound like a broken record. I'm done with the cold. But and my kid, he why would he listen to me or his mom? Before the game, we said, "Hey, buddy, it's going to be cold out there. You should throw on some, long johns underneath your shorts and maybe underneath your shoulder pads. Put on a long sleeve shirt." He's like, "Oh, I'm good, Dad." So we kept telling him, "Do it." No, he's fine. So of course he's out there in just his shorts and his uniform top with short sleeves, and gets in the car at the end of the game. He's like, "Oh my God, Dad, that was the coldest I've ever been." And how do you have sympathy for that, right? They've got to learn. So you can only say so much. But let's turn our attention now to the markets. Wall Street had a good week last week, but interestingly, trading volume was pretty light. And that kind of, I look at trading volume and I look at it as a sign of conviction. And so good week. NASDAQ was up almost 3%. The S&P and the Dow were up 2 and 1.8% respectively. And what started the week off was the prior weekend, you had a lot of comments coming out of the White House that a trade war wasn't in the bag. It's not a sure thing. Don't be freaked out. And then Monday, I think it was, Chinese President Xi was speaking at the forum overseas, and he said that he plans to significantly cut tariffs on imported cars. He's going to reduce duties on other imported goods, and he's going to improve the intellectual property rights of foreign firms. Okay. I will take the short side of that, but we're going to see how this unfolds. I think that Xi, I think Putin, I think that they play this administration like a fiddle, but we'll see. Let's see how that plays out. Over in the Middle East, we had these geopolitical tensions really high because the Syrian government reportedly launched a chemical attack on the town of Douma, which is a rebel-held stronghold, and they killed 40 people. And you see the images on TV. It's horrifying with the children being brought into the hospital, having been the victims of the attack. And so the U.S. retaliated Friday night, and they just launched the barrages, surface-to-air missiles, and they dropped bombs from planes to destroy these chemical weapon making capabilities. According to the U.S. administration, it was a success. The UK and the French said the same thing. So we'll see how that unfolds. I know someone, one country that wasn't pleased, which was the Russians. who came out very strongly and said that it was completely unacceptable and there would be consequences. So we're going to see how that plays out. That's something I'm keeping my eye on. Also, the Middle East, there's a lot going on in the Middle East. I mean, in addition to Syria, you had a missile attack aimed at Saudi Arabia by the pro-Iranian rebels in Yemen, which further escalated tensions in the region. And you saw the Saudi air defense forces intercept a missile over Riyadh on Wednesday. So it's a tough neighborhood, and there's never a lot of calm and stability over there. But with all these headlines, what you saw was the Middle East, obviously oil-rich Middle East. You saw traders move the oil prices a lot higher. For the week, oil was up 8%, a little over 8%, and it closed at $67 a barrel. I think that's like the highest level we've seen in the last 3 years or so. So obviously the energy sector had a big move in the market. And so, just keep an eye on oil prices. It does have a big effect on the pump. And one of the things I've talked about before is, if you're middle class or above, you may not feel that. But if you're a lower income person, you're going to feel that at the pump because your gasoline costs are a much bigger component of your average monthly living expenses. So that's something from a consumer spending standpoint I think we need to keep an eye on. What else happened last week? Zuckerberg testified, CEO of Facebook, was on Capitol Hill. He was answering a lot of questions about the Cambridge Analytica data scandal and the alleged use of Russia with Facebook to influence the shares, to influence the election, and it was his apology tour. There's something about Facebook I can't place it. I get it, an advertising machine, and it is obviously the stock's been fantastic, but I don't get it. I've been on there. I actually just deleted my account. I was pissed off at them. I figured why not? But I know they're an advertising machine, but who responds to these ads on Facebook? Maybe I'm just showing my age. I'm showing my ignorance. It could be. I haven't studied it very closely, but I've always been just suspect of it. And I know everyone loves it as a value stock. It's cheap and it's got all that stuff going on, but it's great. Yeah, if you want to catch up with old friends and you can find it. But there was some interesting during the testimony. Zuckerberg was asked, "Would you charge for the service?" I don't know. How many people would use it if they charge? Maybe I'm going to get a barrage of emails saying you're out of your mind. That of course I would charge for. Of course I would pay for it. Well, I'm not so sure. I don't see the utility in it. But I thought it was interesting watching him up there. I was unimpressed. Friday was a big day. The banks normally kick off the earnings season, and J.P. Morgan, Wells Fargo, Citi. And this is interesting. They all beat the estimates. Revenues were in line. They all had fairly positive, not fairly, but they all had positive commentary. But all three of those stocks were off on the day. They were down. So based on the quality of those earnings reports, I would have thought the stocks would have been better. So that's something else I'm keeping a close eye on. I mentioned Russia earlier. You saw my New York accent come out for a second. Apologies. And they said it's unacceptable, the attack on Syria. So, what could they do? Well, they could do a lot of things. But one of the things, I spoke at a conference in June of last year at the Vancouver Resource Investment Conference. And it's on YouTube. You could just Google Mike Alkin and uranium. And I talked about the uranium industry. And in that, I talked about the risk to the U.S. energy security because of the reliance on foreign imports of uranium. So nuclear power accounts for about 20% of the electric grid in the United States. That's right. So 1 out of every 5 homes or businesses are powered by nuclear power. Most people probably would think it's much less because nuclear power, at least here in the U.S., is viewed as a pariah. But it's also the cleanest and safest form of energy there is. But if you want to debate me on that, bring it on. Send me an email. I'm happy to. I'm sure the greenies will want to come at me. I welcome that. But let's just assume that I know what I'm talking about on that. And so it is the cleanest, safest form. It's 20% of the U.S. electric grid. And the thing about it is the U.S. consumes about 50 million pounds, give or take, some a little bit, years a little more, some a little less, of uranium, which is the feedstock for nuclear power. It's what eventually turns into nuclear fuel. And so that's 50 million pounds a year that is needed to generate 20% of the U.S. electric grid. And the U.S. produces about 2.9 million pounds of its own uranium. So it imports almost all the rest. Virtually all of it is imported. And depending on the year, we import from Canada, we import from Australia, but we import from Russia and we import from Kazakhstan. Major imports from there, also Namibia and Niger. But in any given year of the 50 million pounds, we could see 10 million pounds coming from Russia. We could see about the same that's also coming in from Kazakhstan. So when you think about that, there's a lot of reliance on foreign imports of uranium to keep this power grid running, or a fifth of the power grid. And there's a heavy reliance on both Russia and Kazakhstan. Kazakhstan, for those of you not familiar, is a former Soviet state, still with very close ties to Russia. And Kazakhstan is the number one producer of uranium in the world. Between its own production and joint ventures it produces 41% of the world's uranium. So what could they do? They also, by the way, let me add this. The United States not only does hardly produce any of its own uranium. Uranium by itself cannot power the electric grid. It has to be enriched. So there is an enrichment process it goes through. And the United States does not own any of its own enrichment capabilities in the U.S. There's one facility, but it's owned by a company called Urenco, which is owned by the Dutch and English governments and a German utility. And it's small in the U.S. So it's completely dependent on foreign enrichment. By the way, the Russians own about 55% of the global enrichment market. So it imports almost all its uranium. It has no enrichment. And so that puts it in a perilous situation. And when I spoke back in June of last year, I called it the geopolitical wild card. And I said that the Russians are one sanction away. The U.S. is one sanction away from the Russians saying, no uranium for you. And it created a little bit of a stir, but people said, oh, come on, right? That's not going to happen. The U.S. wouldn't let that happen. How can that happen? Shit happens. So, excuse my language, but on Friday, a draft bill was submitted to the State Duma, which is the lower house of the Russian parliament, to ban all trade between state-owned nuclear company Rosatom and U.S. nuclear power companies. Now, it's going up for possible adoption this coming week. That could put the U.S. in a tough position. Now, I find it interesting. We talk about, you read about mainstream media, fake news, whatever it may be. I read an article today on CNBC. Today's Monday. I record this on Monday for Tuesday's show. That said, I forget the headline, but something along the lines of they don't have much to do. They won't do much. And it went on and talked about what the Russians could do and something about nuclear power, but nothing about uranium, nothing about the situation. And I find it staggering. And I have found it staggering. Number one, I found it staggering that the U.S. allowed itself to get in this position. Back in the early 80s, it was producing as much as it consumed. And then you had the Cold War, or the wall came down, right? And then so from the early 90s for lots of years, the Russians were really trying to become America's friend. And so there was these thawed relations. The Cold War was over and everything was starting to improve. And if you fast forward to today, you really are at Cold War 2.0. The tensions have never been higher. Between Russia and the U.S. And all along, throughout the 80s and 90s and 2000s, there was not a lot of love shown by the administrations towards the uranium miners. It's hard to get permits and licenses, and nuclear power in the U.S. is, like I said, it's there's not a lot of growth here. There's a lot of growth abroad in the developing world, but the industry has just been decimated. And so it really can't produce. And if you think about it, then while it's 20% of the U.S. electric grid, uranium is 30% in the U.S. of the world demand for nuclear power. The U.S. is. It is just stunning to me that the number one nuclear power in the world, from a weapon standpoint, has no ability to produce or enrich its own uranium. The feedstock of power and the feedstock of the bombs, it's completely dependent on outside sources. So from someone who spends a lot of my time looking at the uranium industry, I think this is something you need to, if you are interested in uranium, you need to be putting front and center, because it's important, it's serious, and I think it's just getting started. And speaking of uranium, I'm going to bring on a guest today that is a hedge fund manager that, like me, has spent a lot of his time researching away from the noise of Wall Street, away from the crowd, the uranium industry, and we're going to talk about it. But he and I had the opportunity on, I think it was Friday of last week, a friend of mine who runs a big hedge fund called and said, "Hey, would you like to talk to somebody who's bearish on the uranium industry? He runs a very big hedge fund, and he's very informed, and he's got a view." So, of course, I want to hear. I go to sleep every night thinking I'm wrong in my thesis. On anything, you have to worry about where you're wrong. No matter how much conviction you have, this is a very humbling industry, and you could always be wrong. So you always want to speak to other people who are informed and might have a different view. And, you have to have a flexible mind, and you can't let ego get in the way. You can't let any type of bias get in the way. So I said, absolutely. So I invited my friend Adam Rodman, who's going to be a guest here. He was on a call, and I won't name who we spoke with, because that's, all the conversations I have like that are private. We spent an hour and a half on the phone, which was about an hour and 20 minutes more of my time than I thought was worth it. Because in the first 10 minutes, maybe 15 minutes of the conversation, we were told how much this person knew. We were told how informed they were. And we were told how they had this variant perception. As someone who has built a model, as has Adam, of every uranium mine in the world, every prospective project in the world, every nuclear reactor in the world, has surrounded the secondary market as much as humanly possible, and is pretty well. We are both pretty well informed, but again, like I said, we could be wrong, and we definitely could be missing something. But this was a bearish view that was, I would say, uninformed on some of the key aspects of the uranium space. There was nothing that I heard that was anything other than a very stale consensus view. But there was conviction I appreciate and I like. And it's part of, being a contrarian investor. You are betting against consensus, and you're having to do that and not get your head handed to you. You need to go out and do a lot of your own due diligence and do your own work. And it's not easy, right? Because as a short seller, or as somebody who's long, as making a contrarian long bet, there's comfort in crowds, and you've heard me say that before. But the beauty of this, and I speak to this, I do this podcast for ordinary investors who are trying to pick their own stocks. I'm not doing this podcast for hedge funds or private equity firms. If they're listening, great. If they're not, that's fine. But I do this because what I'm trying to do is share what I've learned over a long career as a hedge fund analyst and at times a portfolio manager, and latter part of my year a partner. What a professional investor looks at, and to try and demystify it, because the reality is, if someone has a average IQ and they have the time and the inclination and the interest, picking your own stocks can be fun, and it's also not that hard. It's really fourth grade math. I say this a lot. It's addition, subtraction, multiplication, and division. It's common sense. But what it really is curiosity. It's peeling the onion back. It's hard work. It's reading. It's asking a lot of questions. It's being skeptical. It's not accepting convention for convention's sake, right? And it goes back to the psychology of investing. It goes back to comfort in crowds. It's easy to do that. I talk about when I go to an idea dinner with other fund managers, when you see someone talk about an investment idea that is mainstream, you see a lot of heads shake up and down. Yeah, right. I know it. Yeah, of course. And it's bravado of talking about a popular investment. Nobody's going to tell them they're wrong. Be it an idea dinner and talk about a short idea that might be something everyone's long, or a long idea that talk about uranium or talk about product tankers or something that's way out of favor. And people are going to say, you're crazy. I can't think of anything better that I like than to be told I'm crazy when you hear about something like that. Because it tells me that consensus, because they may know what the consensus bear case is right. And if you spend the time and you do your own research and you are able to lay out a roadmap for that research, and like I said, the math isn't complicated. You watch people on CNBC and they use big Wall Street buzzwords and all that stuff, and after doing this for so long, that's a joke. And it is common sense, and it's basic math, and it's having the courage of your conviction if your work is able to prove it to yourself that consensus is wrong. And when I think about the conversation that I had, that Adam and I had, I walked away from that with my uranium thesis going, yeah, okay, this is big fund, really bright guy, very confident, but uninformed. And it was apparent 10 or 15 minutes into the phone call. And it increased my conviction even more, if that was possible. And it got me thinking, when I think about, when you hear me talk about asymmetry or risk reward, what's risk reward? Risk reward, how much do I stand to lose versus how much do I stand to gain? And the asymmetry, you're looking for way more potential gain and way more loss, right? So in this particular case, I tried to put myself in the mind of that short seller and said, and keep in mind that's what I did most of my life, right? And I still do. If I'm right, how much further is this stock or group of stocks going down? If I'm wrong, how much further is this group of stocks going up? And when I look at sectors, that's how I think about it. And when I think about uranium, the risk reward is staggering to me on the upside. If I'm right, and again, I could be wrong, but I feel as though my work is pretty solid, and I feel as though that it takes time. And as an individual investor, you have time, you have patience. If you have patience, it's the one thing institutional investors also don't have. They have They have to tell people their numbers every month, every quarter. If you're a hedge fund, if you're a mutual fund, it's every day people look at the stock prices. So you're judged very regularly, and you don't have the time or the luxury of time to let a thesis play out. If you're an individual investor and your money's in your IRA and you've appropriately sized it, which you should do when we're talking uranium, it's highly speculative. It shouldn't be a big portion of your portfolio. It should be an amount that you could afford to lose and feel comfortable about it. But if you're right, what's the upside? And I view the upside as the best risk reward I've seen in my career. So, thinking, talking, being out there, just keep peeling the onion back, and you'll hear more of a steady beat of uranium conversation as these podcasts go on. And, somebody on Twitter, I'm active on Twitter. It's Footnotes First is my handle, if that's what it's called. Somebody tweeted and saying, yeah, his podcast's okay, but who the heck has 2 hours to listen to it? Well, actually, the longest one I think was an hour and 43, but that's splitting hairs. And that's right. It's a long time. And as I responded to him, you know what? I'm working on it. I'm trying to keep it shorter, but I'm also trying to bring on guests that you don't have access to. Most people don't have access to, and I'm trying to educate. And I do it on my time. Most podcasts, you won't hear me hawking anything. And I just try to do it on that time. And as I told him, there's a lot of good podcasts out there. And so if I'm not successful in reducing the length of time of the podcast, I totally get it. But there are some important things that I think are worth sharing with you. And one of them is the guest I have today, who is a hedge fund manager based out of Dallas, Texas. He's a friend of mine. He is a macro investor who likes to look at the big picture and then see where he thinks there's misplaced value on the long and short side, and then do a tremendous amount of work away from Wall Street. He doesn't talk to the sell side analyst. He doesn't he knows what consensus opinion is, but he's not in the noise. And I will tell you, I lived in Dallas and I worked in the Dallas hedge fund community for back in the mid 2000s. And I got to tell you, that group of investors down there are as smart as they come. Guys, one after the next, the men and women I met in that industry in Dallas, in the Dallas hedge fund community, are absolutely brilliant. So I want to bring in today Adam, who has done a massive amount of work in the uranium space. Adam Rodman, welcome to the podcast.
Thanks so much for having me.
So you and I have known each other for a while now, and we have something in common, which we're going to talk about at length, called uranium. But Adam, why don't you tell listeners, who you are, where you came from, and tell us a little bit about Segra and what you guys do.
Yeah, sure. Adam Rodman, CIO and founder of Segra Capital. We're a hedge fund based in Dallas, as you mentioned. I was formerly a partner at a firm called Contrarian Advisors, run by a gentleman named Mark Hart, who I think is a very smart investor, extremely smart investor, known for a lot of his contrarian calls and really for being a thought leader on ideas that were out of the box. Very lucky to cut my teeth working at his firm before he and a few other guys backed me and my team at Segra and starting our own fund. And I think,
the name Mark Hart might be some people might recognize it being associated with housing short, right?
That's right. That was, he had unbelievable returns even before that, but he certainly timed, and I think maybe more importantly, really laid out in the most cohesive way the housing short, and then also a short on European sovereign and financial credit.
Right.
Kind of a similar framework used to analyze both of those opportunities, but they were wildly out of consensus and wildly misanalyzed in the market. And he made his partners quite a return being right on those.
So tell us about Segra. What do you do?
So I think really just to the point, we think that there's an interesting phenomena kind of occurring. There's a series of interesting phenomena occurring in public markets, both as a result of, I think, performance chasing from your average hedge fund who has kind of underperformed for many years now, and also as a result of the passive money management phenomenon, which has, we think, created tons of opportunity on the outer barbells of your opportunity set in global markets. And I was particularly focused on emerging markets and commodities during my time at Corriente, working for Mark. And at Segra, we generally look for macro-levered industries that are either distressed or widely underfollowed by what we think is the mass investor set. And then we look for extreme value underlying those kind of macro opportunities, or what we define to be extreme value. And then on the short side, probably not surprisingly given our legacy, we look for credit and asset bubbles or industry in decline.
So for listeners, I'll break that down. Adam is a contrarian investor. He uses the macro view of the world, big picture view of the world, and then looks for stuff that's really out of favor and that the market is missing. And, you've had some really nice calls in your career, and I think one you and I are working on right now has the potential to be, at least for me, it's the best risk reward I've ever seen. But why don't you tell the audience about your view on uranium?
First and foremost, I definitely agree with you that the opportunity is maybe once in a career, or at least I believe it's once in a career in the nuclear power and uranium market, and that's despite being present for, I guess, what would be considered a few of the biggest industry or macro trades of the last decade or so. And in a nutshell, I'm sure we'll dig into it a little bit deeper, but the Fukushima disaster, we think, almost single-handedly, but in conjunction with a variety of other negative factors for the uranium market, has pretty much created over the last 8 years, which is about the time of an average uranium cycle, a salted earth environment for anybody analyzing the sector. I know you've spoken about it before, Mike, but the market cap has declined for the sector by about 95%. Most of the companies that were on the verge of bankruptcy or had bankruptcy risk have already done so, and so they've been wiped out. And as a result, supply has been concentrated, increasingly concentrated over the last several years to essentially a duopoly of suppliers, all of whom are highly incentivized at the moment to start cutting production. And they are, in fact, cutting production. And what makes, I think, uranium unique relative to other commodities and potentially so asymmetric is that, one, it is trading significantly below its marginal global extraction cost, and certainly way below its marginal incentive cost. And related to that, most investors end up misunderstanding or getting timed out, waiting for those snapbacks and those wild cyclical swings to occur, because the uranium market is different in terms of its demand cycle, owing to how utilities end up contracting. So I know I threw a lot out there, but long story short, we think we're in an environment where we're at the bottom of the contracting cycle from utilities who have zero incentive to buy, regardless of the price, the underlying price of uranium, kind of until it's time, for lack of a better way of putting it. So low prices don't necessarily entice buyers into the market, unlike, let's say, the oil market or the copper market or other commodities and energy industries. But what does is when they are at the bottom of their contracting cycle and the future ability to have supply delivered to them becomes endangered. And we think that we're at that point on the demand side. And then on the supply side, we think reform is relatively easy in the sense that, again, supply is controlled by a very concentrated set of hands. And with the price in the market, even in the contract market, below, in just about every case globally, below the economic cost of mining it. We see no reason why supply will continue in the way that it has over the last several years, meaning we think there's a lot of upside.
I agree. One of the things that struck me early on in looking at this was, and this is more to the art of investing, but with the commodity down 95% and the number of companies having been decimated, I think going from 500 down to 40, what struck me was the lack of institutional ownership in the group, because the market caps are so small, it's hard for them to own it, for any decent sized fund to own it. And if you're a small fund, you don't have the resources to devote to getting up to speed on the uranium space, because for me, it's the most complex, opaque market I've ever analyzed. And then you marry that with most of the sell side firms, the investment banks who would write research on it, have disappeared. And they disappeared because there's no banking business to be done. And they're not very charitable folks. They don't stick around because they like the CEOs. So you have this vacuum, this void in information. And the narrative is easy. People take comfort in crowds. And the narrative is so obvious on uranium and the bearish narrative that it's just enveloped the narrative, the bearish case. When you think about it, so for me, by the way, that meant that's great. Let me model every mine in the world, every reactor in the world, and secondary supply, and let's go from there. What role does that? Let's try and educate the audience a little bit that may not be familiar with how a professional manager thinks about going at a commodity like uranium and trying to find value. How does your own variant view get formed? What do you do to get that?
Yeah, that's a great question, and stepping back for a second, as a smaller hedge fund, and certainly one that, at least for today's market, invests in pretty unconventional corners of the world, we often get asked what possible edge we can offer our partners, that a multi-billion-dollar, 200 analyst staffed fund couldn't do. And it's exactly opportunities like uranium that we debate that question over, because I think you're absolutely right. In this type of distressed market, when there's no banking business to be done, when the forecasting teams at all of the world's best investment banks have been fired many, many years ago, there actually is an informational edge to be gleaned here, we believe. Whereas, not to be too lighthearted about it, but whereas we believe the incremental value add that we can offer on, let's say, what Apple is going to do the next quarter would be very, very small. So very specifically, I think, or to yourself, we have gone mine by mine globally. And while the exercise isn't practiced often, it's easier than you'd think relative to other industries, because there are actually not that many around. On the flip side, so that's the supply side, we model mine by mine. And unlike the consulting groups, which are kind of the main supplier of information to the market right now, we price adjust the supply that we think will come on. And we use scenario analysis on the production based on that pricing to what we think is more accurately forecast mine supply. Put in a simpler way, and I think you've talked about this at length, Mike, it was very surprising or even shocking, to notice that the information, the supply information that's generally fed to most of the utilities around the world, essentially assumes unlimited prices, or doesn't take any economics into account. So a mine may need $80 uranium to produce economically, but most of the data being filtered into the market by these consultants assume those pounds come to market, even if we are at a $21 spot price environment, as we are today. And I know you've talked about this a lot, but it's almost difficult to believe that
you
most
can't,
people that is
right?
inefficient.
Adam, having analyzed businesses, you say you're joking, right? You can't actually think this when you're thinking about how they formulate it. It's unbelievable.
It's unbelievable, and it's a head scratcher. But in a world, I think that is that throws around the term informational edge very loosely, we believe there is actually one to be gleaned here, and it's only because there is nobody professionally applying kind of the basic ABCs of, let's say, commodities modeling to uranium. And we do the same on the demand side. Most consultants or forecasters out there take very high level aggregate data, usually presented country by country, and loosely say that this is what a country's nuclear as a percentage of the energy mix looks like, and that translates into X, gigawattage of power. And we just get more granular with the analysis and do a reactor by reactor model for pretty much every single one that's in operation globally. And we can, we know, we've talked about that at startup, you need 2 or 3 times the amount of uranium as your running quantity. And so inflection points in startups make a very, very big difference in demand. And I think we're seeing that more real time than most of the data would reflect.
Somebody on Twitter, they were talking about there being a surplus up till 2025. And I mean, like you and I have talked, and we've each built our own models, and we could not disagree with that more. And we, think it's much. I think it's in deficit right now. But this person came back and forth with me and was very confident in their assessment of that. And at the end of the day, when I asked what the numbers show, how the workup to the numbers came there, it turned out it came from the World Nuclear Association, which is what we were just talking about, does not factor in the economics of future supply. And it's a staggering realization. But like you said, and I always say this to people, this is 4th grade math. This is taking the time to model the 450 reactors in the world, go country by country, how many reactors are coming online or going off, and be conservative in that, and look at the planned and proposed, right? It's, if you can add, subtract, multiply, and divide, but spend an enormous amount of time understanding this portion of it, you have a light bulb moment, right?
Yeah, I certainly think so. And I think that people forget the effects of illiquidity. Not only illiquidity in terms of share volume in various stocks, but also the kind of illiquidity of, let's call it intellectual illiquidity in a market, and what that creates. And when you have a lack of debate in an industry, that I think is so pervasive, or there aren't many examples of which are so pervasive as in the uranium market, you oftentimes, I think, lose an intellectual honesty over some of the assumptions, which end up being very important to driving macro forecasting and then your ability to make money in a certain sector. And when we're talking about uranium, that intellectual illiquidity really surrounds or really is defined by mine economics.
Yeah. And
to throw out a few examples, one of the big question marks out there for anybody analyzing the space is the Husab mine in Africa, which is being developed by the Chinese. And the mining analysts that do exist, which are not, most of whom are not, or all of whom, frankly, are not macro guys. They are mining analysts, either with geological degrees or maybe mining engineering degrees, et cetera, but who are looking at companies really just looking at, let's say, resource quality or the cash flow of a certain business. They are using an input assumption that is coming from third parties who, again, we don't think are doing the intellectually rigorous work. So back to the Husab mine in Africa, guys, most analysts are plugging in double-digit million pounds per year coming out of this mine, which one, and I believe you've talked about this, Mike, is facing a handful of operational and logistical hurdles to producing anything near what the consensus has.
Correct.
And even that would be assuming that they wanted to produce those pounds, given that these guys are somewhere in the $70, $70+ per pound economic sphere. $70 for everybody that's listening. $70 price is more than 3 times the current spot price of $21. And so to think that these pounds are going to be reasonably produced over the coming years, we think doesn't make a lot of economic sense. And this is just one example of several inefficiencies we think exist in this market that actually make it relatively easy to analyze. And it makes us very bullish.
I talked earlier about how the current narrative is easy to adopt. Once in a while, because you are public and I'm public with our discussions about a lot of different things, people will come at us with the bear case. And, you and I had a swing earlier today by somebody we wouldn't name, but a bright person that we were told had a really in-depth bear case on uranium. And to what you said earlier about encouraging debate, because at least this person came at it with some context around the conversation. And I would say that it would, personally, I thought it fell far short. But debate is in the market, which is good because this is a $1 billion+ enterprise fund manager, at least looking at it. So that I consider a good thing. So let's talk about some of the issues that are out there from a debate standpoint. If we think about the cost to extract is 50-ish for the average miner, and it's selling for 20 right now. What would you say to somebody that says, well, that's not the utilities problem? Why would they pay more than that? It's what the market will bear. How do you answer that?
So I think that stepping back, the contract cycle comes back into focus. If people are worried about how and why mines have been able to supply utilities, I guess put in your words, why should the utilities care? Well, the utilities only care if they're getting supply. And given the nature of the way that uranium supplies are secured in the market, which is via long-term contract, the utilities haven't had any security of supply issues. Because even as the spot price has dropped and dropped precipitously, large suppliers, let's just use Campco as an example, have been selling into contracts that were struck at much higher prices, in many cases at the prior cycle highs. So from a business model perspective, they've been operating just fine and have been happy to mine their $40 uranium and sell it at a 2011 or 2010 or 11 vintage contract that was over $80 and make a pretty good margin. And even more important than those single contracts is the way that their aggregate contract book looks relative to their aggregate cost to extract. And until very recently, they were still in the money. So hopefully, I'm taking this in the direction that you
absolutely. It's fantastic. Keep going.
If anybody listening or professional investors are sitting around pondering, for instance, why Campco decided to shut down McArthur River, which is the world's, I guess, arguably, but the world's biggest mine, largest, and why they decided to do this all of a sudden, right? Because if everything's fine in the market, why would the lowest cost producer with scale shut down? And it's not a coincidence that last year that backlog of historical contracts, for which the aggregate earnings of Campco is based, peaked, meaning that if prices don't rise, they'll make incrementally less money going forward on their aggregate contracting book. And so they have to, right? The market, again, remember, in commodities 101, generally over time, the price of the commodity tends to track the marginal cost curve globally. But in illiquid, inefficient, inelastic commodity markets, we can often trade significantly below or above those marginal costs for various idiosyncratic reasons. And I would argue that the idiosyncrasy in the uranium market is the fact that a heavy, heavy backlog of rich contracts were struck in the prior cycle, which allowed big supply to continue entering the market irrespective of the spot price. And the fact of the matter is that those are just turning. So why is it the utilities problem? I guess in a nutshell, it's the utilities problem because they are largely unfunded on their future delivery schedule, meaning that the security of supply is not yet set going out over the next 5 years. At the same time, as effectively the world's duopoly of suppliers are saying that they're not going to play ball anymore at low prices. And I think I've just explained what caused at least Camco to shift, because Atomprom is shifting for slightly different reasons. But nonetheless, we've seen cycle over cycle that utilities don't particularly care what price of uranium, what price they're paying for uranium. But at the end of the day, at every inflection point in the cycle, security of supply is the kind of buzzword. And in previous cycles, the market actually never got undersupplied. So everyone that's kind of squabbling over 1 million pounds a year here, again, on, let's just say on a 200 million pound per year market or so, squabbling of 1 million pounds here, 2 million pounds, 3 million pounds here, I think are missing the forest through the trees. The fact is, what really is going to drive this cycle are requirements for future deliveries. So your view on where utilities are in the contracting cycle. And then on the other side of the ledger, Camco or Comprom's willingness and ability to fulfill those pounds and at what price. And I think we're at the cry-uncle point, as evidenced by the shutdown of MacArthur River, the supply discipline that we're seeing out of the Kazakhs, et cetera, which says, hey guys, this market for years has not reflected a real price. The real price is what the marginal cost is. And given that we're not getting fed from the old cycle anymore, we're not selling you pounds here, at least not out of our minds.
So we have primary mine supply that is not incented to bring production on. So you have closures like we're talking about, or temporary closures, or in some cases you'll see some permanent ones. So some people have said to me, well, when the price starts to spike, you're going to see new mines come online. And people sometimes mistake this with natural gas, where you could put a drill in the ground and 6 months later start flowing. Talk about the timeline in the world of uranium and the incentive price for most of these potential new mines to come online.
Yeah, I mean, I think that's the beauty. That's one of the beauties of the opportunity. Undoubtedly, there have been a few people. I think less so in the professional investors, but certainly some, who have been quote unquote wrong for the last 2 years in terms of the uranium cycle turning. And a lot of bears actually would probably point to that crying wolf as a reason to stay bearish, right? A lot of smart people thought the prices were too low 2 years ago. And I'm not saying that there's some validity maybe to that criticism of people who have been bullish for the last 2 years, except to say that being bullish in 2015 was logical. And this does tie into your ability to bring new supply online. And the reason I think that it was logical to be bullish in 2015 is because new projects, soup to nuts, new mining projects, take 8 to 10 years to discover, plan, permit, and then bring into production. That's a long time. To your point, I'm sitting in Texas. It's not like I can drive east or west for 2 hours, capital in some open acreage, and essentially have a flowing, producing asset a few weeks later. This is a very, very, very long lead time proposition. So most participants in the market, including those consultants, which we believe are are wrong in their analysis, or at least not being as transparent as they could be in terms of their analysis, expect that towards the middle of the 2020s, we start to not only go into deficit, but relatively significant deficit. And it continues from there as the world's best assets start tapering off, which they do aggressively in the mid-2020s. So the reason I think most people got excited in the 2015 time frame is that if it takes 8 to 10 years to explore, plan, and permit a mine, and even the consensus in the market believes that there's an undeniable deficit going out into 2023 or 2025, backing into the numbers around 2015 to 2017, there needs to be some global incentive to allow new mine supply to come online a decade later. The fact that the price hasn't moved to bring that supply online, just throwing a little bone to the guys who may feel like they've been shortchanged in their bullish view over the last couple of years. But just because the price hasn't moved since 2015 in any material way, doesn't mean, in my opinion, that those bulls were wrong. What it means is that the spring is coiled even more tightly, and that the cycle gets prolonged even longer. So perhaps I'm being a little long-winded for you and your viewers, Mike, and
no,
for that I apologize.
It's great. Keep going. You're
well,
welcome
if anyone's yawning, I do apologize. But in short, what I mean when I say that we've prolonged things is that 8 to 10 year time frame hasn't changed. Supply discipline has come online, which even the bears can't argue has put the market into closer balance, if not a deficit, in a shorter time frame. And the longer term deficit is just as radical as it was 2 years ago, but now has a much, much, much smaller, or frankly even an impossible chance of being made up for in time by new mines coming online. And again, we just, we're not extreme guys. We run things by the numbers, and this is just what the numbers tell us. So even if magically, to your original question, magically prices popped to $50 or $60, and a few marginal projects got greenlit as a result of it. Let's not also forget that $50 or $60 for a few months or even a year may not be enough, right? I mean, somebody needs to feel comfortable enough with the long-term price forecasting to build a decade-long asset that takes a decade to build. Most listeners probably know how to or are familiar with the DCF and how time frames can skew your total return or your IRR. You need prices for elevated prices for a long time to make anybody comfortable investing hundreds of millions, if not billions of dollars in a new project. So bottom line, because of the nature of the way this cycle has developed, we will not be seeing significant new mine supply come online until a best case, 7 years from now, in our opinion. There will be some expansion of current mines if prices get high enough, which maybe get the market closer to balance. But again, as not even in balance, but in a smaller deficit. But as we've seen in prior cycles, of which occurred in a surplus environment, the idea that utilities may not be able to fulfill the uranium needs that they have going forward, we believe strongly suggests that we will have a aggressive and prolonged price cycle as they get pulled into the market and don't care what price they pay as long as they can secure supply. The bigger risk is that the supply isn't there regardless of the price.
So for those who may not be familiar with uranium, it's an interesting market because we're talking about supply and demand deficits or surpluses. One of the fascinating aspects of the market is, for going back to probably 1985, the market has always been in a primary mine deficit. It has not had enough production to meet up with world demand. But in the interim, so you say, well, how can you have a surplus then? Well, there's another function to the market that has been a drag and an overhang for the last several years, and that's called secondary supply. And secondary supply is, as it sounds, it's sources of supply that come from other than the mines. And for years, it's come from, there was a program called Megatons to Megawatts, where the Russians would take the enrichment levels down on their highly enriched uranium and de-weaponize essentially nuclear bombs and turn into low enriched uranium for nuclear power. And they would send about 10 million pounds a year into the market. And then the Department of Energy in the United States was sending in up until recently when that stopped, was sending in about 7 million pounds a year in the market. And then you saw the Japanese would sell some of their excess uraniums into the market after the Fukushima meltdown, and those reactors were sitting idle. So there's sources, but a big source has been something called underfeeding. And it's a fascinating topic. It has been the 800-pound gorilla of secondary supply, and it's been in the market as a big overhang. And I get excited when I think about the near to intermediate future with regard to secondary supply. And I personally think it's one of the areas that people don't quite either understand or miscalculate. What's your view, Adam, on the underfeeding market? First, explain to people what it is, and then share your view with it.
Sure. Essentially, and I know you've talked about it at length, so I won't go through the full discussion, which you could probably devote a whole series to in and of itself.
But yeah, we could do underfeeding 101, but yeah.
Yeah. But the idea that that enrichment facilities globally essentially spin the tails of nuclear fuel to create more supply, which they then sell into the market. And similar to a nuclear reactor, it's very bad to shut down an enrichment facility. So they essentially are, I wouldn't say forced into, but kind of forced into continuing their operations. And the excess material that's created from this extra spinning ends up being tails in a process that's called underfeeding. And these pounds have essentially been indiscriminately sold into the market, adding to pressure and oversupply. Other sources of secondary supply have been inventory selling. You mentioned also the megaton to megawatts project, which is petered out, but for many decades, or for 2 decades in particular, was a big. And then, if you want to call Department of Energy transfers and or other state transfers, if you want to separate that from inventories, then you would also have those kind of contributing to the secondary overhang. And in full transparency, secondary supplies are the more difficult element to model in this supply demand forecasting. To a certain extent, the inventory data in many cases is held at the government level and therefore isn't readily accessible. Underfeeding requires some assumptions around enrichment capacity, frankly, pricing. You've talked a lot about the SWU market, et cetera. But for our listeners, and just given that we have a relatively finite time to walk through all of this, the way that we at Segre Capital look at this, at least, is what levers can be pulled to increase secondary supplies going forward.
Yeah.
And when we analyze each one of those subsegments of secondary supply, kind of in order here, underfeeding would be driven by a growth in enrichment capacity. Given where SWU pricing is right now, that is not an economic endeavor. And if anything, we're seeing the shutting down of that capacity. So not a very big likelihood, in our opinion, that you see some aggressive expansion in underfeeding or underfeeding led pounds into the market, because we don't expect that there's going to be a large expansion of that capacity in the market. Inventories are another item that bears and market commentators like to talk about a lot, but we think is almost always put in the wrong context. So in terms of selling, the best intel that we can kind of find is that most of the inventory selling, again, outside of the DOE and a little bit maybe out of Russia, was coming from the Japanese. And that's not so surprising, given that Post Fukushima, they were operating several years without any reactors running, and frankly, with a lot of skepticism about whether or not their reactors would ever come back online. It's very interesting to note that since they began starting their reactors, they had not been present in the markets as a seller. And I think it would be a very big leap to assume that given their reactor ramp, and another one was just restarted successfully here in the last few days, that they will not sell inventories going forward. It's again a bit not practical to believe that when you actually had uranium requirements going forward, that you would be selling your inventory. And so again, bottom line, we don't, I think, have as much informational edge on the secondary supplies as we do going mine by mine and figuring out what can economically be produced. But the test that we overcome is what circumstances, again, would drive an increase in secondary supply. And with megatons to megawatts behind us, with the DOE doing a significant pivot on the way they view transfers, given that Japan is restarting their reactors and the big question mark over their inventory seems to be cleared up for now, and the idea that in this depressed blue price market, with enrichment capacity coming offline, that somehow we're going to reaccelerate and spend hundreds of millions, billions and billions of dollars on enrichment capacity in an uneconomic environment, again, doesn't make sense to us. It would take something that is outside of reason to shift each of those factors. So to be conservative in our modeling, we even flatline secondary supply. If hand over heart, I think we're going to see secondary supplies drop over the coming 5 years, but we say that they are able to maintain their current level and things still look attractive.
Yeah, I mean, I take the same tact on that. I flatline them as well because you don't want to overestimate, and it still makes me feel pretty good about where we are in the market. So we've talked about the supply, we've talked about primary supply, we've talked about secondary supply. Let's shift gears a little bit, and we've talked about inventories. Let's shift gears and talk about the demand side of the equation. You manage Segra Capital. You have a global macro view. You've been around the world. You've seen things, and you think outside of the borders of the U.S. to form your investment view and to look for ideas. I was fortunate throughout my career to be able to travel to many countries and think globally, and in the same way that you do. And when I talk to people who are not familiar with uranium and I talk to them about nuclear power, I get that scrunched up nose. They give me that crinkly look. Definitely not a popular topic at barbecues or cocktail parties. And the answer I get from most people is, well, uranium, it's terrible. It's unsafe. It's dying. Does the U.S. still have nuclear? And where big pools of capital are in the U.S. who could come in and buy these uranium miners, there's a narrative that nuclear power is a dying industry. I take a different view of that, but why don't you share your view about how you look at demand and demand domestically, demand globally, and let's separate it from OECD countries to non-OECD, so developed versus developing world. And in your analysis, how you factor in closures, because in some parts of the world, we are seeing closures. We've seen the Germans shut down. Switzerland is going the way the dodo bird. So talk about, your view of demand and how you think about where you see it contracting.
Sure. Well, that's a great question, and I couldn't agree, with you more. Here we are scratching each other's backs time and time again, but the industry is priced as if it is going into, a cold winter when the numbers prove that we're really talking about a growth industry here. And as if, a total collapse in the investable market cap, again, falling by 95% from 120 some odd billion of investable market cap to $6 billion of investable market cap, as if that wasn't enough in terms of creating chaos amongst investors, the sources of demand have totally shifted as well. So most of the headlines, most of the analysis around the future of nuclear power continue to be run by what I would call kind of the old guard of nuclear power demand, which was in the OECD. The US, Japan, Western Europe, Korea, these were traditionally the big players in nuclear, and generally were responsible for the inflection point in terms of growth rate of the industry at various times during the cycle. So, as recently as in the Clinton administration, the U.S. was supposed to be going through a nuclear renaissance. That created, a small, a bump in the world's perception of demand, for instance. But today, and I believe, again, this is another reason why such an asymmetric opportunity exists in markets that are supposed to be efficient. The old world is stagnating, is the way that I would put it in terms of nuclear demand, whereas the non-OECD world is growing and relatively rapidly. And China is by far and away the biggest driver of demand going forward, but India, Russia, the Middle East, parts of Eastern Europe, parts of Latin America and Northern Africa are all jumping in to try and build out their nuclear industries. And without simplifying the topic too much, we're in a world right now dominated by interesting, sexy ideas like electric vehicles. And I think we've all witnessed how euphoria, whether justified or not, around the likes of, say, Tesla becoming a real player in the car market, or related lithium, as a niche commodity, or cobalt may have enormous leverage to the global trends in terms of our behavior. Behavior being using electric vehicles versus fossil fuel driven cars. But no one is yet really connecting the dots to how this affects our energy grid. And so there are a few assumptions that we all have to realize are essentially true, which is that if we are going to be a global economy that is more reliant on steady stream baseload power, and because of the way that the entire world thinks about the environment today, meaning that we increasingly need incremental power to be clean, there is no solution for energy grids, particularly developing energy grids, for clean baseload power outside of nuclear. And so, there's a lot of focus, for instance, a little tidbit to throw out there, but the market got very excited about the announcement out of China in Q3, I think, 2017, that they were going to aim to ban fossil fuel-driven cars by 2030, sometime in the next decade. And the lithium-related stocks went ballistic in the market. Tesla got a leg up as a result of it. And what very few people realize is that for every electric vehicle added to the highways in China or to the roads in China, increases emissions in their country. And the reason for that is that when they plug into a power grid to charge their electric vehicle, it's pulling power from a coal-fired plant. So a
little known factoid.
Little known factoid. So there's no doubt in our mind that China absolutely is serious about their pollution problem, and that they want to be a thought leader. Frankly, they don't even have a choice.
If they don't want to have civil unrest because people are dying from air pollution, they need to get it under control.
Yeah, absolutely right. Absolutely right. So there's no doubt in our mind that they're serious about it. It's just that nuclear is happening slightly behind the scenes. But if they're going to build 8 reactors a year and aim to have a 200 reactor large fleet, in the next decade plus, remember the current fleet is just 450 or so, and that's what's been built since the late 1950s. They want to have 200 in the next decade. To underestimate the extent to which this is a growth market going forward, we think is foolish. And and particularly when you overlay that demand trajectory over the valuations that exist in the marketplace, in terms of what resources that are going to be supplying fuel, uranium and then fuel to these upcoming reactors. Again, you'd think that nuclear was actually going away. They're being priced as if we are in a structurally declining industry, and the numbers don't support that.
What on the uranium thesis bugs you? What do you feel like? I might not have my handle around this, or here's where I'm wrong, because you and I have spoken in the past, and we speak to people who call us and they think they have that aha moment, and they say, aha, what about Germany? And how about Switzerland, right? Or they see a nuclear power plant in the U.S. get closed, and right away the email or text or phone call comes saying, yeah, look at that, right? And, yep. If you're like me, I have a model that took a really long time to build, as did yours. But like I said, it's fourth grade math. And when you plug the numbers in, you say, okay, yeah, figured that, got it. So, but still, I've been wrong a lot in my career. I've been right a lot more than I've been wrong. But, anyone who tells you that they've always been right is full of shit. So, I've been wrong, and I've learned from my mistakes in the past. And I'm always thinking I'm missing something. So what is it that you think you could be missing in the uranium space?
Certainly I think you have to be, as you mentioned, as an investor, able to point out the weak points in your argument. And so I think we've narrowed it down to about 3 that we really try and do as much work on as possible. 2 of which we can reasonably assess, and 1 of which is just a hands up in the air type of problem. The hands up in the air type of problem is another nuclear meltdown, right? I think just from a sentiment perspective, I think when you know as well as I do, when you look at the data, whether it was from Fukushima or any of the other nuclear disasters, even when you count those, nuclear is one of the safest energy forms out there. But nonetheless, it is a devastating event. It's horrible for the area and the surrounding community. It can be very dangerous, and I'm not sure that the world could swallow another event such as that. But that's completely out of our control. Most of the reactors are now undergoing new safety standards, which we think make such a scenario less likely. The reactors in question, right? I think actually you used this analogy on one of your other podcasts, but a lot of these reactors are like driving around in an automobile from the 1950s to the 1960s and wondering why they perform poorly in a crash. We forget that these are, in many cases, 50 or 60 year long assets. And because of safety standards from the past, they were not appropriately updated. Needless to say, that's changing going forward, and so we don't find it likely. But if you're asking about risks, without a doubt, a meltdown, whether caused by a natural disaster or human error, would be a very bad thing. And we just have to be open and honest about that.
Yep.
The two that we can do, real work around are global inventories and China demand. And taking them, I guess, in order, a lot of bears will point to global inventory levels, which are in aggregate between at the utility level and the government level, estimated to be somewhere between 800 million pounds and maybe 1.4 billion is about the highest estimate that I have I've come across. And so, as the thesis goes, even if we were to go into a 50 million pound deficit per year, let's say we could draw down about a decade worth of inventory before anyone had to bat an eye. And here are the rebuttals on this one, which is that, one, in this commodity market, and frankly all commodity markets, inventories are necessary. Do you factor into your oil, crude oil supply-demand forecasting, what would happen if all of the strategic petroleum reserves globally were flooded into the market. Most people wouldn't, because we could never do that. If you think that oil is important on a long-term strategic basis, then uranium is extremely important, because if you ever run out of inventories and you cannot get it somewhere else, you have grid shutdown, and there is no replacing it. So inventory levels, just as a point, are always and have to always be higher in uranium. And in the context of historical inventory levels, we are currently elevated. And as a third point on inventory levels, just so people understand, in other bull market cycles, inventories have been higher relative to future demand than they are today. So it is generally not a driver of price. But since we're talking about bearish arguments, it could delay. We could, I guess, reasonably draw down something like 10 years, worth of deficit. Deficit in the market could be supplied by inventory. But as a last and I think most important point, and I know, Mike, you and I have talked about this a lot, there is absolutely no reason in our mind why any utility would do this. Because stepping back for a second, the price of uranium is not expensive. No utility is standing around or sitting around, unlike other commodity markets, right? Usually if demand is waning, it is because prices are too high. There's one of the reasons, because prices are too high. But demand is inelastic in uranium. The price of it has nothing to do with the buying patterns. And so right now, if you were to make the argument that they're going to draw down on inventories instead of buying material, again, buying material at a fraction of its marginal cost, you would be making the argument that they are choosing to draw down inventories or their long-term safety to avoid paying for a commodity that is somewhere between 2 and 5% of the cost of operating the reactor, or nothing. A relatively de minimis amount, certainly relative to, let's say an oil or a coal-fired plant where feedstock is maybe 80% of their cost structure. And from speaking with utilities, from understanding the way that the contracting cycle works, I don't even think the thought of inventories or drawing down on them in any material way is crossing the mind of any major utility over the long term, especially because the price being down here only delays the inevitable, right? No mine in the world is making money at $20 uranium. So if you draw down inventories today, and even if you can do it for 5 or 10 years, then we're sitting here in the 2020s with a worse problem, an even worse problem than we have today. And everyone understands this. Okay.
I'm sorry, go ahead.
Yeah. No, go ahead.
I was just going to say, I'm a visual guy. So when I look at the numbers, and I like to do charts, and I think that the question, you just nailed it. What's more important, the price they pay or security of supply? Let me share a little numbers with you. In the long-term market in 2003, now we'll say the market started turning 03, 04, but uranium had gotten down to low teens, high singles in price per pound. But let's go back here and look at some numbers. In 2003, when the market was getting pounded and nobody wanted uranium, in the long-term market, we saw 50 million pounds. And then in 75, the long-term market contracted 75 million pounds. As the price of uranium started to turn and go higher, and why did it go higher? Because the buyers were worried about securing supply. In 05, there were 240 million pounds purchased. In 06, 210 million, 230 million in 07. And that's when it peaked. So when they have a fear of supply shortage, they bought 5 times the amount of uranium 2 years later than they did in that prior year. I mean, to me, that nothing more. And by the way, and then it goes on in 08, 09, you saw 125, 140, 250 million pounds in 2010. They were buying to secure supply. And that's what matters to a utility buyer. So for all the bluster, for all the talk, for all the we're not paying this price, you're paying to keep the lights on is what you're doing. And the only way you do that is by having guaranteed mine supply. At least that's my view.
I couldn't agree with you more. And then in terms of the investment opportunity, not just to be throwing kind of silly numbers around, but the entire market cap, public market cap of investable uranium assets globally, let's say it's $6 billion.
Yep.
Right? The idea that that price, $6 billion, accurately reflects security of supply for what is 10% of the global energy grid. 20% of the U.S.'s energy grid, 60% of our clean energy is a farce.
Yeah.
Over the long term. Given that these are, again, 40 or 50-year-long assets for which we still have new ones coming online at an accelerating rate. It's the numbers aren't exactly related, but we always bat around in the office. It's odd to me that currently you have $500 billion in hammers swinging construction on reactors when the fuel that is going to supply them out into the future, the total market cap is $5 or $6 billion.
It's crazy. And I'll add one other thing. One thing I didn't say when I pointed from 50 million pounds up to 240 million pounds a year. At that time, there were 23 reactors under construction and 44 million pounds of new mine supply coming online. Today, there are 60 reactors under construction and no new mine supply, with the exception of Salamanca, 4 million pounds in Spain over the next year or two. So you have almost 3 times the amount of demand and no mine supply coming online. And as we talked about earlier, it can't come on until the mid-2020s. So, if you said earlier, people can't separate the forest for the trees. There you have it. And here we sit at the price of uranium. But just, that's why it just takes a little bit of time and for it to work its way through.
Yep. Yeah. I couldn't agree with you more. And I think the only thing that I would maybe, kind of conclude the uranium discussion if our listeners aren't sleeping.
Yeah, they're probably uraniumed out, but that's okay.
Uraniumed out. The short last thing to think about is just escalating geopolitical tensions.
Yep.
I think a lot of people, because of how small, relatively speaking, of a market that uranium is, underestimate how precarious of a position global utilities are in, given where supply is concentrated. And particularly with the sanctions recently announced on Russia, we think that there is a real risk in the market that Russia potentially bans or alters the rules on nuclear fuel and uranium exports to the U.S., if not to the rest of the world. And before people kind of yawn at that statement or throw it away, don't forget that the U.S. alone imports 95% of our uranium. And as of the Section 232 petition from our U.S. producers to the government, they believe that Russia and Russia-controlled entities supply 40% of our of supply. Our estimates put it more at 50 to 55% of our supply. Today, it was announced, actually just, I think, while we were on our call, that the Duma is potentially voting in Russia on a retaliation via changing these rules on nuclear fuel and uranium export to our markets. And Mike, I'll maybe even turn it to you, but what do you think happens if we're not allowed to import Russian or potentially Kazakh material?
I think the U.S. market is hosed because people say, "Oh, we'll go to Canada, we'll go to Australia." They got contracts with other people, so it's not so easy.
What do you think happens to the price?
I think the price goes to prices we haven't seen before.
I agree.
I think it goes parabolic.
And it is not being. Look, maybe it happens, maybe it doesn't. The fundamentals are good enough, I think, on their own.
Yep.
But people are worried about the impact on tech companies globally. What effects these trade wars will have. We're looking at the stocks, the companies that are controlled by the Russian oligarchs, and the market is taking an extremely strong view on the impact of what these geopolitical tensions are going to have. And despite my bias for being bullish this sector, I think numerically, objectively, there is no market that would have a more pronounced fundamental shift as a result of tensions or retaliation than the uranium market. or said differently, there is no market, at least that I'm aware of, that can have as big of a unilateral impact put upon it than Russia deciding to restrict exports.
Absolutely.
And yet it's not being discussed.
Yep, I could not agree with you more. And we've talked about this geopolitical risk, and it is one. Look, let's take the U.S. for example, and we'll wrap up uranium then. The fact that in the early '80s the U.S. was producing to its consumption of demand. We use 50 million pounds a year. Back then it was in the 40s, and the U.S. was producing 40 million pounds. And the fact that now it produces 2.9 million pounds and consumes 50 million pounds a year of uranium, it's not only the fact that it doesn't have the uranium production online because the miners can't make money at these prices, it doesn't have enrichment capabilities, right? And at least the Iranians have the ability to enrich their uranium, right? We don't own any productive enrichment capacity here in the United States. The U.S. doesn't control it. The conversion of yellowcake into UF6, which is part of the nuclear fuel cycle, the second stage, the only plant in the U.S. just shut down. They can't make money. So the fact that this is the number one nuclear power provider in the world and the number one nuclear bomb maker in the world and strongest nuclear power does not have any self-reliance on the nuclear fuel cycle is staggering to me. And should any of these things geopolitically play out, where the Russians choose not to send uranium or enriched uranium or anything into here or anything else that causes that fuel cycle to hiccup, the price of uranium will go to prices, like I said, I think we've never seen before. And you know what will happen, Adam? And we'll be watching congressional and Senate hearings or House and Senate hearings, and they'll say, by God, how did this happen? Well, it's been happening for 25 years. The whole cycle in the U.S. at least has been falling apart. All right, let's shift gears for a second. Share with listeners what else you like. Let's go around the world, long and short. What's exciting you on the long side?
Oh man, I get to talk about it even more. I really thought you had me on here so that we could just be totally aligned and beat everybody up on our bullish uranium views.
Nope.
Well, but
I'm putting you on the spot. What else you like?
No, that's great. I'm happy to talk about it. Maybe it gets back to my introductory comments. Basically our investment process looks for what we think are misunderstood inflection points in industries, usually cyclical industries. So not dissimilar from your background, from what I understand, Mike. We look for cyclical inflection points, usually in nichier markets where we think, for some identifiable reason, the market is either wrong or unwilling to look at the shifting assumption. And I'll keep it really brief since we've been going on for a while, but the shipping markets have been a disaster for many, many years, half a decade plus. Most of the pan investor set, certainly the professional investor set, because of market cap, again, Wall Street coverage, et cetera, mainly looks at dry bulk and maybe container shipping. On the tanker side of the shipping market, they exclusively trade crude tankers, so guys that ship dirty crude around the globe. But we like and have liked for quite a long time the product tanker market. So it's a small subset of the shipping industry, but that runs on completely different supply-demand fundamentals than their stepbrothers, and it's looking really, really good. Asset values again.
Talk about product tankers. What do they ship?
Yeah. So sorry. If crude tankers transport dirty crude around the globe, product tankers generally get refined products from global refineries, such as gasoline, jet fuel, chemicals, et cetera, and transport them around the globe. And usually what drives a shipping cycle, demand, certainly in the product tanker market, but in a lot of markets is generally kind of a left to right, slow and steady trajectory, driven by general usage of both crude and refined products increasing, which is a function of population growth, et cetera. But there's less to be doing on the demand side, maybe much less than, say, you could even do in the uranium market. But usually drives the cycle is your analysis or your future view on the order book of new ships that is going to hit the market. The amount that somebody who is transporting refined product around the globe is willing to pay per day for your ship, otherwise known as a charter rate, is what generally drives the economics and the business models of these companies. And when new ships or the ship fleet is in short supply, rates are higher. And when there is an abundance of ships, rates are lower, not surprisingly. So the future order book and the number of new ships coming in, because we kind of are on this slow and steady demand trajectory, is really critical to understanding where rates for these ships are going to go in the future. And the dry bulk market's kind of been its own mess. Container markets, same thing. Crude tanker markets were heavily affected by the OPEC decision going back a couple of years ago and supply cuts. And the product tanker market has been baby out with the bathwater. But putting our analysis in a very brief nutshell, asset values, so the ship values, are at 20-year lows. Most of the publicly listed companies trade at a discount to those 20-year lows in vessel values. The last time vessel values were here, the order book as a percentage of the fleet was something around 50%. Meaning if there were 100 ships in circulation, 50 new ones were planned to come online. Currently, the net order book for ships, despite ship values being back where they were when new orders were 50% of the book, the order book now is at about 2% of the fleet, the net order book, which doesn't make sense to us.
No, so, it sounds like uranium 2.0.
Yeah.
Right?
Well, we look at things, that should definitely rhyme. And so, we stay kind of out of the mainstream of things. We take a very long-term view on cyclical businesses that, we hope to time everything right, but where valuations support us being patient. And again, buying vessel values at discounts to extremely depressed values when the forward-coming fundamentals look really, really good. And we know what the rest of the market might be ignoring those really good fundamentals, sets up well for us. That's another long idea that we like. And,
you want to share a short?
Ardmore Shipping is kind of our favorite in that space. The ticker.
So your favorite long shipper, product shipper is Ardmore Shipping.
Yeah, the ticker is ASC. Adam.
ASC. What about a short? You want to share a short?
Yeah, sure. So our short framework looks for what we think are asset bubbles and or industries that are facing decline. And one of the areas where we have been focused for a long time. I'm half Swedish actually. My mom is a Swedish national. I'm actually a Swedish citizen. I spend a lot of time there. And the Nordic markets are ripe with inefficiency. Kind of captive domestic investor base. A lot of concentration with maybe not passive money, but less discerning money, let's call it, which we think creates a lot of opportunity, kind of on the bottoms up, from a bottoms up standpoint. And then the macro is something that we've taken maybe a differentiated view on, but in short, it's a bubble economy, we think. And one of the reasons we think it's a bubble economy is because coming out of the financial crisis relatively unscathed, the country with positive demographic tailwinds and a banking system that could, unlike maybe some of its European peers, grow their balance sheets relatively aggressively, entered into what we think is now a full-on housing bubble.
So how do you express that view?
Yeah, so I won't go through any names, I don't think, on our call here, but any of your listeners who want to get a dialogue started, I'm always willing to pick up the phone for people who allocate to guys like us. But there are little niche businesses, particularly in the financial space, little companies that emerged out of nowhere to lend to levered consumers, which we think are very vulnerable. the interest rate cycle there. So essentially, for currency reasons and fear of recessionary risk, have been kept artificially low there for a very long time. All mortgages are floating rate. Until very recently, there were no amortization requirements. So it has been a borrowing bonanza. And I won't take a view on the big banks because in many ways they're well run and decently well capitalized, and you need to make stronger assumptions on the macro to want to be short. But these smaller niche lending industries, again, that were hot IPOs in 2014 and 2015, growing their balance sheets 300%, 400%, 500% over the last couple of years, lending to a very leveraged consumer to begin with very low provisioning, look dangerous to us.
Wait, where have I heard this story before?
Yeah, and we have a little bit of experience with credit bubbles.
Yep. Hey, man, I can't thank you enough. I really appreciate you joining. I want to have you back. I'll have you back in a few months. We'll see how the uranium thesis is playing out, but I really appreciate you taking the time.
Absolutely.
And Adam, how do people get a hold of you?
I believe, if you don't mind me shoveling this back off to you, you have my email.
Yep.
I'm up just about 24/7. So if anybody reaches out to you and you feel it's appropriate, you're welcome to pass that along.
Perfect. Great. Hey, man, thanks again, and we'll speak soon.
Yeah, I love the show. Take care. Thanks so much for having me.
Thanks, buddy. Hope you enjoyed the conversation with Adam. I speak to a lot of guys in the hedge fund industry, and he's a great thinker. He really is very bright, very diligent, really, really, really smart guy and a good guy. And I hope you enjoyed the conversation. As you can tell, I've ramped up the uranium conversations a little bit. I like to share with you what I think are interesting opportunities. And so that's it for now. I will be back next week with another guest that I think you're going to find very interesting. Have a good week and stay cautious.
The information presented on Talking Stocks Over a Beer is the opinion of its hosts and guests. You should not base your investment decisions solely on this broadcast. Remember, it's your money and your responsibility.